Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the soybean complex for Wednesday, July 13th. Starting off here with a daily log scale chart of the November soybean contract and reiterating our recent updates, the importance of the bullish divergence in momentum when the market had a chance to really sell off sharply on that late June, early July break below the May lows. The consequence of that bullish divergence in momentum could be long-term to the upside, as not only does this define the 1286 low from June 30th as a very reliable low and support and risk parameter to a resumed bullish policy, it reinforces the prospect, the very bullish prospect, that all the price action since the February 10th high at 1403, again in the November contract, is merely lateral and corrective. That, on the heels of last year's secular bull trend shown in the this weekly log scale close only chart, exposes the resumption of that major bull trend to new highs above that 1433 high weekly close. You can see the deterioration in the bullish sentiment according to our MRT Bullish Sentiment Index that the February through July aimless lateral chop has produced. The bearish divergence in momentum from that February sell-off has been neutralized and is no longer an impediment to move either way. As a result of the definition of that 1286 low on an intraday basis and a 1309 low on a weekly close-only basis, until or unless the market can prove weakness below these levels and risk parameters, we anticipate a resumption of the secular bull trend. Looking here at a monthly log scale chart, we anticipate a break above the 1456 high from February. And you can see beyond that point there's really no levels of any technical pertinence between 1456 and the 1636 all-time high from July of 2008. These issues considered, a bullish policy, a generally bullish policy is advised, with weakness below 1286 required to negate that and re-expose a major peaking and reversal threat. And from a shorter term perspective, if there's a one little caveat, it's the fact that the market has returned, looking here at an hourly chart, the market has returned to the middle half of the past quarter's range, where the risk-reward ratio of initiating a directional play is rather poor, so that traders have to make the decision to either take a step back and take a longer-term risk to that 1286 low, or play it very tightly with a very conservative risk assumption. And we believe that in this regard, yesterday's 1341 corrective low, if the market cannot sustain above that recent corrective low, it will jeopardize this developing uptrend, confirm a bearish divergence in short-term momentum, and expose an interim corrective setback that we believe would provide an outstanding risk-reward buying opportunity. In lieu of weakness below at least 1341, further and possibly accelerated gains are anticipated straight away. Moving to a weekly log scale chart of the soybean oil contract, you can see that very similarly to the bean analysis we just discussed, the market's ability to recover from that June sell-off perpetuates this year's generally lateral, consolidative, corrective behavior that, on the heels of last year's major bull trend, we believe re-exposes that bull trend to new highs above that 6041 high. Looking here at a daily bar chart, we've got a confirmed bullish divergence in momentum as a result of last Thursday's recovery above 5746. The market's still relatively early in this recovery, and we'll be discussing a buy recommendation later on this morning. Not only does this market define the 55, by virtue of this bullish divergence in momentum, the market has defined the 55.48 low from June 30th as our key support low and risk parameter. This market is now required to fail below to mitigate any broader basing and reversal threat and re-expose a larger degree reversal lower. As long as that 55.48 low holds, so does the long-term bullish prospect that all of this year's merely lateral price action is corrective, consolidative, ahead of a resumption of last year's bull trend to new highs above 61.45. From a very short-term perspective, looking here at an hourly chart, that does not yet reflect the overnight gains to what have been a 57.84 high. By virtue of these overnight gains, the market has, we believe, defined the 56.70 corrective low from yesterday as the latest and tightest corrective low. This market is now minimally required to fail below to jeopardize this developing bull trend, and until or unless such weakness is shown, we think this market's got the ability to catch up with the bean and meal strength that has been put forth over the past week or so. We think that that produces a favorable risk-reward buying opportunity in the Dec contract around the 57.70 area with protective sell stops just below 56.70. Finally, looking at a daily chart of the soybean meal contract, you can see the extent to which this market has rebounded following that bullish divergence in momentum last Thursday above the 345.40 level. That arrests this June sell-off, and we believe defines the entire April through June sell-off attempt as merely bull market corrective. That is now resuming the secular bull trend to new highs above 370. Looking here at a weekly log scale perspective, the market did have a chance to produce a major reversal lower when it broke below that key April 337 low. But obviously the market has failed miserably to sustain those losses and has bottomed promptly around a pair of Fibonacci relationships between 329 and 327 that we think contributes to the prospect that this year's entire sell-off attempt is merely bull market corrective, that ultimately this long-term bull trend from last year is resuming and quite possibly still in the relatively early stages of resuming, to eventual new highs above the February high at 391. You can see the deterioration in the sentiment levels to the least bullish conditions this market has seen since the May 11 rebound from the lower recesses of the range, and also back to July of 2010, or even in the case of our MRT Bullish Sentiment Index of managed money positions reportable to the CFTC, as low as that we've seen since the December 08 period. From a shorter term perspective, on an hourly chart here, you can see the developing uptrend with weakness below at least yesterday afternoon's 351 spot 40 corrective low is the minimum required to threaten this uptrend and expose an interim setback attempt. But in such a short-term bearish divergence event, we advise traders to first approach that sell-off attempt as a corrective buying opportunity, again ahead of a resumption of last year's bull trend to new highs above that February high up at 391. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trade.